Hello, everyone. Billy Brown here from the Investors Capital Group. Going to go over a key calculation that depository lenders use that you need to know about, and they won't tell you. So, yes, this is going to be new to you and could bite you in the ass if you don't know it. Now, there's a lot of non-depository lending out there that doesn't factor in what we call global debt servicing, but the banks are starting to come back online and starting to lend more money for either owner-occupied, especially, but also non-owner-occupied investment properties. So they're going to start coming in with a little bit better rates to entice the borrowers to get back on track. You need to know how they calculate their global debt servicing as well as cash spreads. And I'm going to show that to you in a very high level way. So let's just use for example, an investment property, doesn't matter what it is, if it's a multifamily or an office building, retail building, whatever it is, income looks like this. We all know how to calculate a debt service coverage ratio. It's got $1 million gross income or $83,000 a month. You subtract out your vacancy and credit losses, about 5%, and that gets you your effective rental income. You can have some other income in there from parking to laundry, etc., CAM, whatever it is, doesn't matter. It's usually minimal that you can prove that you actually collect that. Add that in, you've got your gross operating income. You subtract out your total operating expenses. I'm not going to itemize all those for this video, but it's roughly should be at 65% of that gross operating income. So right now we're tracking at 627 for operating expenses. That leaves us a net operating income of $337,750 or $28,000 and some change a month. So this income, net operating income, will allow us to cover a loan payment that looks like this. We're going to assume this loan payment is $3 million on a 25-year amortization at 7%. That gets us a total payment of $21,203 or a 1.33 debt service coverage ratio. That means for every dollar of debt, that brings in $1.33 of income. That is a proper use of debt. I'm going to click over this to show people that aren't used to this, how that works. So it is these numbers, this number divided by this number equals this. So everyone got that? Net operating income over your income divided by your expenses equals debt service. Okay, now let's go on to how banks calculate global debt servicing. They want to see that you're not bleeding out the other side, as they speak. So you buy something that does cash flow, but it's trying to cover up something that doesn't cash flow, which is you. So this is what most lenders have to go through to determine this. Yes, it takes a lot of time. And yes, this is why it takes 3 or 4 days to get you a term sheet back to be able to underwrite it, because they have to go review all your tax returns and spread them out. It's called cash spreads. So every single lender is going to want the same things. If you looked at my ebook, last 3 years of tax returns and your PFS plus details on the property. So from the top down, it looks like this. You've got your borrower 1, borrower 2 could be a spouse, income, and their salaries and wages, all that. You're going to add in your interest and dividends. If it's recurring, means it's recurred over the last 2 to 3 years. Capital gains, IRA, all that, but it's got to recur over the last 2 or 3 years. And then we're going to factor in your Schedule C, E, and F for your tax returns. You can add back in your depreciation and interest expenses. And if you don't have that, you can subtract out your principal and interest payments. Same here on E, and then same thing on F, which is your farm income. And then any kind of distributions here, add those in for your K1s, any other income, child support, or other divorce income. That's non tax returns that you have cash flow and can actually prove you're getting, then it puts it here as well. Now this calculates out a total annual income. Last 3 years, you can see this is declining. I'm going to get that in a second. You're going to take out the tax income taxes, which is also on line 1040. That's what they do. And then this is the part that most people miss and don't understand this. Estimated living expenses. I'm going to park out on this for just a little bit. This possibly has gone up since inflation, but most depository lenders are going to hit you for living. Yes, you have expenses for living. It's usually right around $10,000 per adult or $7,000 per child. This is one of those hidden expenses that you have no idea that they do, that I'm telling you right now, you need to ask about if you're going to depository lender. What do you use to estimate living expenses when you're doing cash spreads? Memorize that question. Mr. and Mrs. Banker, when you do my cash spreads, what are you using for estimated living expenses? They will tell you that's usually $10,000 per adult, $7,000 per kid. In this case, there are two adults and one kid, so we're taking out an additional $27,000, which in 2025 seems kind of low, but that's what they do. Now you have a number called net cash flow available for debt service right here. So this is what can be used for debt. Now, again, back to it's getting lower. I'm going to get this in a second. Most lenders are going to use either average those out if they're about the same, or if they're getting lower, they're going to use the most low one to the lowest year to determine the number to be able to use for your global debt servicing. So we got our income here that's available for debt service. Now we're going to factor in what is our debt payments. So they're going to include your home mortgage, credit cards, auto leases, HELOC, whatever it is. All your creditors add up, and it's going to be annualized. In this case, we got 44,562 across the board, and they're going to say net cash flow after debt service is this. So after they pay all their debts, these people have $21,000, roughly $22,000 a year to free cash flow. And that is roughly a debt to income ratio of 67%, which is very, very high. So that's a red flag right there in this case. All right. So what does all this mean? Well, like I said, normally a lender is going to average out 3 years of this. But because this year, the most recent year, in this case, 2024, is lower, they're going to use this number to determine the global debt servicing. So let's go on global debt servicing. What does that look like? It's very, very simple. We're going to take the net operating income from what we're buying or refinancing in this case, which is right here. We're going to take the net cash flow from us individually, which is roughly this down here, divided by 12. This is our total income. Same thing here. Debt. So your debt service for your CRE is here. Personal debt service is here, coming off those numbers. And you get total debt payments of roughly $24,916, roughly $25,000. So you have a global debt service of 1.35 and a debt service coverage ratio of 1.33. All right, so that is pretty good. I'll tell you right now that a depository lender is going to be probably in the yellow on this. They're going to like the debt service on this, but they're not going to like the debt service on this. Now let's go back and actually look at if we had another kid, right? And I'm just going to add it right here, see if we can do this live. So we're getting that another $7,000 versus $34,000. See what happens. So now our net cash flow available for debt service is this number. What does this look like? That went down. We're still at 133. It's going down. So you're still pretty good there. So if you have another kid, you're okay. Although that's probably numbers going to go up because kids are really freaking expensive. But let's just pretend, let's look back here on the cash spreads. Take this back out. If your income goes down significantly, or your debt service goes up significantly, that is going to play a factor in your debt service. Now, if you are self-employed and have some really funky taxes and you're showing nothing, nothing down here for income, you are not going to be able to get a loan from a depository lender no matter what. You're either going to need two things. One is you need to find somebody to sign on the loan that actually looks good on paper on their global debt service that has the experience necessary for that loan. Or the good news is we have lenders out there that will actually work with borrowers that don't care about tax returns. Yes, that is correct. All they care about is this over here. So as long as this number is 133 or higher, or actually 1.25 or higher, you can get a loan no matter what your tax returns look like. So if you've been declined by a bank, please reach out. We would love to take a look at this and help place your loan and find you funding for your project. in places that don't need tax returns. Hope you guys enjoyed this video. Let me know if you have any questions. Bye.